Welcome. We're going to have an economic conversation. I'm Sarah D, and this is...
I'm Dr. D. Do I have broccoli in my teeth?
I hope not. We haven't had broccoli for a few days. Ooh, okay. So, we are going to talk about balloons a little bit. These are percentages, okay? This is a higher percentage because there's more air in it, okay? This is money. This is the money supply. Oops. And this is the money supply. This is the greater money supply. This is the lower money supply. What do I mean when I say money supply?
Well, okay. What do you mean by money supply?
Yeah.
That's how much money there is allocated to the economy at any given time.
That's such an interesting concept. I think that's interesting. Did you know that there is a certain amount of money that is allocated to be in American dollars, at any given time? Not necessarily the actual green dollars themselves. I mean, it could be digital money as well that, like, you use with your credit card or the
debit card.
The debit card, the amount in your bank that says you've got this much in there. Well, actually, that much isn't in there. Only 10% has to be in there, correct?
Well, yes. That's
currently
that's what the Federal Reserve requires. Yes.
Yeah, that's the requirement on banks. So this is the money supply. Okay, currently, is this our money supply or is this our money supply? What's going on?
Right now we've got a big one.
Right now we have a big money supply.
Do you know why we have a big money supply?
You're going to tell me why.
We have a big money supply because the federal government and the Federal Reserve during COVID wanted us to spend a lot of money.
They did.
In order for us to spend a lot of money, what did they have to do?
They gave us money.
They gave us money. It was a beautiful thing.
But we also wanted to spend a lot of money.
Yes, of
Do
course.
we always want to spend a lot of money?
When it's being given to us, I'm okay with it.
Yeah.
So yeah, that's exactly what happened.
Okay,
so the money supply got big.
It got fatter. So before COVID, it was like this. After COVID, it was like this. That does something to the interest rate.
Yes, the big fat money supply caused itty bitty interest rates.
How did it do that?
Well, do you want to really know? This is way and complicated.
Maybe I don't.
No, you don't want to know.
Okay.
Just the market does it.
The market does it. That's what happens. The Fed does this or does this. And when the Fed does this or this, the market does this or this. If the Fed does this, then the market does this.
Yes.
And the marketplace is not controlled by anybody but you. You are the marketplace.
You are, yeah. You're a piece of it.
Yeah.
A small piece. So it's not even controlled by you.
But you have a part.
You have a part, yes.
You blow that.
Yeah. Beautiful.
Okay. Help me. I'm not asking any questions anymore. I know I have stuff written down.
So the reason that you wanted this post is right up there.
Yeah, because
you listen to
Tom Keene
from Bloomberg News.
Yeah, and
he said essentially that the Federal Reserve, with its policy tools, could not affect the current state of inflation.
And the Federal Reserve doesn't have policy tools.
It has a policy tool.
To do that, yeah.
Yes, it has a policy tool. It controls the money supply.
It controls the money supply.
Right.
Right now it's here, and they're
moving it to there, yes.
They're moving
it to there. They're doing a good job of it.
And they're moving it to there because they want the market to affect the interest rate to be here.
Yes.
And the reason they want the interest rate to be higher is because if the interest rate is higher, we will spend less money, right?
We'll spend less.
Okay, I got that far.
Yeah. So what is it that everybody's worried about right now?
They're worried about inflation.
Okay, so they're worried about inflation. So price levels, inflation is the rate at which price levels change. And so we have a high inflation rate, 7%, 8%. inflation rate. That means prices are going up 7 to 8% a year. And that makes the money less stable. That is, it buys less and less stuff every year. And we talked about money, and money needs to be stable. It needs to be a store of value.
Otherwise
it becomes ineffective and you don't trust it. So the Federal Reserve changes the money supply in order to stabilize its purchasing power. And they target an inflation rate of about 2%.
To stabilize the money's purchasing power. That's great.
That's right. Okay. And so your money buys 2% less stuff than it did year after year. And that's just what we targeted at. That's what we've agreed upon as a country that is reasonable. So that's what we've agreed upon, and we feel good about it. But 7% or 8%, we're not so agreed about that, right? So the question is,
People get upset.
how do you affect that growth in prices? How do you slow down the growth in prices?
It has something to do with this.
Well, clearly the Federal Reserve is going to do something, but it only controls the money supply.
That's right. That's all it can do. It can only do this. The market does this. And so we're going to talk about how the market does this.
So first,
Is that right?
well, we aren't even there yet.
We're not even there yet.
Right? So what causes prices to go up? Or down, for that matter. It doesn't matter.
When prices go up, it's because the person who is selling things either doesn't have enough for the demand of the market. Say 10 people want one thing. They don't say, well, first one come. I don't know, maybe they can do that too, but they raise the price so that whoever wants it the most will buy it.
Yes, so the person who wants it the most gets it. In a sense, that's very good for the economy because the person that values it the most is the person that gets it. If the person that values it the most doesn't get it, then you've wasted some potential benefit on somebody who valued it less. So that's a problem. So you need to allocate it. So if there is a supply side shortage, there's going to be an upward pressure on prices.
So they'll go up.
So we can think of it, there's one thing and 10 people. We can think of it as there's not enough being supplied. But what's the other potential?
The other way, say the whole question one more time.
There's one thing and 10 people want it.
No, but the original question that I came up with that scenario with.
What was going to cause the price to go up? Yes.
Yeah, the price
But
to go
there's
up.
two things that
Cause the price to go up. Yeah, I'm trying to.
One is the supply side.
Yes.
What's the other side?
The others.
There are too many people that want it.
Well, that's kind of what I just said.
No, you said there were. Okay.
It's kind of.
So we talked about the supply side, pushing the price up. The other side is, right, so you said the producer
only has one.
raised the price.
So yeah, because the producer, right? Because the market is the producer and the
Right,
the
but you
consumer.
said the producer raised the price to allocate it to the person that wanted it most. Another way to say the same thing is that the consumers bid up the price. The producer just sat there and goes, huh? And the consumers bid up the price until the person that valued it the most
So the
got
market
it.
can work either way.
Either way. So one is due to pressure from the seller, and the other is due to pressure from
the
consumer.
But they're observationally equivalent?
Until there's a change. And then you ask, what changed? So we sit and we look in a market, and it's in balance. The number of potatoes that you want at the price are constant, and you go to the store and you get the same number of potatoes week in, week out. And
So we're gonna say before COVID things were constant.
we had this
Okay.
relationship, and then something changed.
Yes.
So when we say COVID happened, the something changed is you're not allowed to go to the store, and the person that's driving the potatoes from the farm to the store isn't allowed to drive potatoes from the farm to the store, and people aren't allowed to work in the store, and all of these
There's
things,
all kinds of hand
all
slapping
kinds of
going on.
hand slapping and stuff going on. But essentially what happens is in potatoes it didn't happen, but in lots of other things. So for example, movies. Did you want to go to a movie theater and get coughed on by somebody with COVID?
Nope.
So the consumer stopped going. Well, if the consumer stops going, there's too many movie theaters and not enough people. So what has to happen to the price?
It has to go down.
So the price starts to fall down. Because of what?
Because
What was the change?
The demand was less.
The demand side changed, right? So we can talk about a demand side shock, or we can say the same thing. COVID happened and people still wanted to go to the theater, but the theaters got blown up. So there were fewer of them.
Well, they were disallowed from doing it, right? Basically, they did get blown up.
And so there would be, right? So, I mean, you can think of it as being a supply side shock as well. There's lots of things that can happen. There can be demand side shocks, there can be supply side shocks. And now the question is, what can you do something about?
And by you mean the Fed.
The Fed.
What can the Fed do to make it so that that the market supports a lower inflation rate?
Right. And so Tom Keene was of the opinion that after COVID, what happened when COVID went away? Didn't go away. What happened when COVID restrictions were relaxed?
Well, people started driving more, so the demand was up, and so the price had to go up because...
So now you're talking about where the inflation comes from.
Right.
Where the inflation comes from is that there's this big demand side change. Is that the only thing that there was?
No, things were clogged up and probably still are at the ports.
And we get a lot of stuff by imports.
Right.
And some of the countries that we import from are still not opening up for trade and that kind of stuff. So the stuff that we want isn't available.
Right.
Isn't as available, right? So we end up with something happening on the demand side. Consumers want more stuff because they can get out and do it. Producers would love to sell it to them, but they can't get enough.
Nope.
So the way that
and even the supplies they get are more expensive, right?
Some of them are, yes. But so anyway, that pushes up the prices that we in the economy face. And so we're talking about the price of everything, not a particular thing.
Right.
The price in general. Some things may have gone down in price. You never know. Some things have gone up in price. Gasoline gone up in price, right? So some things may be coming down in price. Housing may be starting to come down. Who knows, right? So it just depends, right? So we're buying a bunch of different things, and on average, prices are going up too fast. The Federal Reserve can do what? They can change the money supply. They made the money supply big. Now what are they going to do?
They're going to make it smaller.
Make it smaller. Interest rates were low. Now what's going to happen?
They're going to go higher.
They're going to go higher. So let's ask, what happens when we're in this world? Small money supply, higher interest rates.
We don't spend as much.
We don't spend as much. In particular, people who are buying on credit buy less because it's more expensive to buy on credit. So when I say buying on credit, that means during COVID, you were less likely to replace your dishwasher. But your dishwasher was going to be bought on a credit card or on credit extended by whoever it was that was extending the credit. Mm-hmm. COVID's over with. You want to buy the dishwasher. Everybody's buying dishwashers now on credit. Money supply is restricted. Interest rate goes up. Fewer people are willing to buy the dishwasher now. They're going to make the old dishwasher work a couple more years.
Because there's less money and the interest rate is not worth it.
Right. And oh, by the way, we've talked about it like the only people that are buying things in the world are normal you and me's. But some people that are buying things in the world are like Ford Motor Company. Yeah. And they're buying factories and they have the same problem. Money supply goes down. Interest rate goes up. It's more expensive to build a new factory. So they make the old one do.
So the feds lower the money supply with their magic checkbook. We've talked about that before, correct?
Yep. Interest rates in the credit market go up, which is fine. Purchases are restricted, slowed down. And if they're slowed down, what happens to the rate of change of prices?
It goes down.
It goes down, right? So that's the theory that we've got going on. And that's what the Fed is trying to do.
And that's the power that they have.
That's the power that they have.
And the reason they learned that that power was useful has to do with the Great Depression.
Yes.
They learned lessons, and we have not gone in a Great Depression since then because of the Fed.
Now let me ask you another question. No, leave that up there.
I'm leaving this up here.
Right. So they reduced the money supply. The interest rate has, the markets, in the credit market interest rates have gone up.
Yeah.
What does that do to clearing the ports?
They stay more clogged.
They're still clogged up. What does that do for making China ship more stuff?
It doesn't do anything.
Doesn't do anything. So it does nothing on the supply side. So if our inflation is due to both a demand side push and a supply side pull, so if both of those things are happening, all that the Fed can really affect in the short run is the demand side push. So the inflation that's due to supply, usually you'll hear in the news, supply chain problems. So supply chain problems not going to be fixed by this.
And that's what Tom Keene was saying.
And so that's what Tom Keene was saying when he says it wasn't going to. He is postulating that most of the inflation is due to supply side pull, and that the Fed can't do anything about that. But to the extent that there's demand side push, the Fed has power over adjusting that. How many people want to buy things? The Fed has the way of adjusting that. And so that's so if you look at Tom Keene's, he's assuming that it's all a supply side issue. But we know that coming out of COVID, it's not all a supply side issue because
It's both.
it's both, right? It's both.
And so it will, in the short run, raise interest rates, but in the long run, they will go down.
They not guaranteed.
Really?
In order to make them go down, what has to happen?
Because
So-
we're changing both.
Only if the Federal Reserve decides to. But but you're talking about the long run. That's a good thing. So the question is, what is the cost of this? Right? We don't get it for free.
We don't get a high interest rate for free.
We don't get a high interest rate for free. We don't get a low money supply for free, and we don't get lower inflation for free.
Everything there are no.
There are no solutions.
They're only
They're only trade-offs. They're only consequences. You're absolutely right. So let's talk about this. A lot of the credit side market is by companies
Okay.
building factories. So I decrease the money supply, I increase the interest rate.
So they don't build as many factories.
So what happens to long-term
So
growth?
It slows down.
Slows down
because you
long-term.
don't have more.
So that's the cost. The cost is it pulls down long-term growth. Right? We have fewer factories being built because the interest rate is too high to build them. That may be good or may not be good, but it does slow down economic growth.
And what the Fed does is they change it up.
Oh, yeah.
They'll increase the money supply when they think things have moved enough in the market.
If they think another problem is coming, they only target
They can.
inflation is the target that we're talking about right now.
Right.
So they will only increase the money supply if the inflation rate gets too low.
This is not the inflation rate. Okay.
Nope.
Yeah.
They will only increase it if the inflation rate gets too low. Otherwise, they'll just leave it and we have a period of slower growth.
Yeah. And a period of slower growth is better than breadlines.
Yes.
Which, if they weren't getting in there and messing about with the money supply, having that control, we could have breadlines.
Sometimes we can't. It's not clear that this 7% inflation is a bad deal.
It just is. It's what is required
It's what is required to make you buy less. And it's what is required to make companies want to sell more. And those are two, right? So there are economists that say, leave it alone and it'll come home, wagging its tail behind it.
And
And
The Fed doesn't believe that. The Fed is filled with...
So the answer to your question, what do they believe? Yes, they know that's true, but they think there may be more short-term pain because the market could cause big crashes.
And then people get all emotional and they start killing everybody.
Who knows? Yeah, it could be bad.
People get...
Right.
We're too emotional
But
sometimes.
that's just it.
Especially when it comes to money.
So Tom Keane spoke truth to the supply side, missed if there's any demand side push in the inflation rate.
Okay, so we're good, huh?
I'm perfectly
We
good.
said something. I still get confused with this. I try so much, but that's okay. If there's something that you didn't understand about this, and you have a question about it, something you disagree on or something, please let us know, and this weirdo will address that. So anyway, we thank you for joining us, and I'm Sarah D.
I'm Dr. D. Namaste.
Make it a great day.